In this video, I'm going to show you and go through with you the actual profit and loss statement for 700 Mitchell Drive, this 21 unit apartment complex that's for sale right here, workforce housing in a high demand area just up the street from North Kings Highway, one of the busiest roads in our market, and the ocean, one of the most popular places in our market. Yes, we're going to cover that profit and loss statement. I'm also going to give you the biggest takeaways from the profit and loss statement and questions that I'd be asking the seller if I was an investor looking through this profit and loss statement. You heard it. We're going to cover it right now. I don't want to hold us up. Let's get into this video. But first, hit that like button, hit that subscribe button, and pick up the phone and give me a call, guys. It's 843-360-1737. I always enjoy hearing from savvy investors looking to learn how to invest in commercial real estate in Myrtle Beach, South Carolina. Let's get into this video now. You'd like to invest in commercial real estate. I'd like to show you how these properties make profit and break down all their expenses so you understand how they operate, how they appreciate over time, and how this will impact your taxes. I'd also like to let you know the property's cap rate and how it compares with similar properties in the market, how the location best services its users, and the potential for future growth. I'd like to fill you in on the historical and future occupancy trends, as well as potential management structures affecting the investment. And we won't miss the investment's risk profile nor the best exit strategies. Yes, we'll cover the condition of the property, any value add potential and repositioning, but we'll also dive into special topics like customer base, market positioning, and marketing and booking strategies when it applies. And if you stay tuned until the end, I'll show you my top picks for the best commercial real estate deals that have generated the most annual profits, have the highest appreciation, and the best tax implications. So no matter if you're a first-time investor or a seasoned professional transitioning into the real estate game, or perhaps simply a casual investor looking to relocate to the beach to live, play, and invest so that the passive income can support you in your retirement years, whether you have 20% to pay down because you're financing or you're a cash buyer, if it's a commercial real estate investment that you're after, you'll be better because I'm aiming to give you a 10 times return on your time for watching my videos until the end. Guys, back behind me is 700 Mitchell Drive, a 21 unit phenomenal multifamily property right here east of Business 17. We're going to dive into the profit and loss statement for this property. Now let's work through some of the biggest takeaways here. The actual cap rate is closer to 12% than 9%. The actual property profit and loss shows a total income of $275,359 with total expenses at $34,116 with a net operating income of $241,243. At the $1.9 million asking price, the actual cap rate comes out to about 12.1% based on the profit and loss statement. That's dramatically better than the 8.89% cap rate shown in the marketing package or the financial model that I built. Now, I made some adjustments to it because I didn't see a line item for property management. I didn't see a line item for insurance. So, and again, those are questions we can dive into with the seller if you want to move forward on the deal. Now, why this matters. 12% cap rate in Myrtle Beach is rare if the numbers are accurate and sustainable. Now, if you haven't seen the rent roll video, guys, you need to watch it. The numbers are solid. This has got a 90.5% occupancy rate. It is workforce housing, highly sought after and highly in demand in this area. This is a positive cash flowing property after financing from day one to the tune of almost 10.8% cash on cash return, to be specific, 10.79% in the first year after you pay annual debt service. So this is not just a this is not a pushover property we're asking you to buy because it might appreciate well. This is a property that makes money from day one after financing. Now, number two, expenses look extremely low. Total operating expenses here were $34,000 for 21 units. The expense ratio is essentially $34,116 divided by that $275,359 in total income on the property. So your expense ratio comes out to about 12.4%, which is extraordinarily low, a little bit unbelievably low in my opinion, which is why I factored in some additional cost, especially since I didn't see them in the profit and loss statement. Most multifamily properties operate in that 35 to 50% expense ratio range. This immediately tells me two things. One, either A, the owner is paying major expenses outside the property and loss statement, or B, this is a truly unusual operating situation. Missing major expenses. I do not see property taxes, insurance, and property management. Those I added in. You can find that in our other video on the property where I break down my financial model on the property. They're not actually on the P&L though. Now the broker pro forma does include taxes, insurance, and management. Those three line items alone total roughly $68,000 annually. This explains why the broker net operating income is much lower than the actual net operating income. The biggest due diligence question we have here is where are taxes, insurance, and management being paid? All right, now HVAC is the largest repair expense. Repairs are $18,124 annually. Largest category was HVAC at $75.30. That's over 40% of all repair cost. The investor takeaway immediately is, let's ask these questions. The age of the HVAC system. How many units have new HVAC? Any remaining original systems? I would want to know that immediately. How many of these systems are we expecting to die in the next 5 years? Because that's a capital expense you're going to have to pay for. Obviously, this could indicate deferred capital expenditures ahead, and I would want to plan for that, and I would want to have a reserve in place, knowing, hey, if, out of 21 units, 10 of them or 11 of them have, HVACs that are original, well, those are probably going to have to be fixed in the next 5 years. All right, maintenance costs are surprisingly low. For 21 units, general maintenance labor was $3,570. I know that seems a little bit low, and I get it, but the work that's being done on the property, from what I can tell, is like handyman work. So it's not really outside of the norm of what we see a lot of the times in Myrtle Beach, honestly. Pest control, $550, landscaping, $450. There's not much landscaping to be done out there. Cleaning maintenance, $955. Again, I think all these categories are just very, very simple. That's a total maintenance of $5,525 annually. It's very efficient for a 21 unit property. At the same token, it's workforce housing. So, it's the location and the demand for it is there. So people are willing to pay those prices to be at this location. And if they're willing and they're paying and the building's not broken, well, why invest a ton more money into it? I think that's probably what's going on there. Revenue is fairly stable. Monthly rent collections, mostly between $20,500, $27,700 monthly. That's a relatively stable workforce housing income stream. No major revenue collapses, no obvious collection issues that we're aware of. Guys, very simply, we're already at Ocean Boulevard. You can see you got the Blue Hotel here. You can just kind of look around. Like, look at this, guys. Like, look, this is a nice little spot here. What is this? The Myrtle Beach villas, and then we've got some retail shopping here, which is really nice. And we've got some other properties across the street, and we're oceanfront, guys. That fast. All right, so I'm gonna walk us back up to the property. All right, so the property produces about $12,000 net operating income per month. Monthly net operating averages $12,100 per month. Several months did exceed that at $24,000 and $25,000 net operating income. This is a strong cash flow for a sub $2 million acquisition. Repairs don't suggest deferred maintenance disaster. Common red flags would be massive plumbing bills or roof replacement or foundation repairs or repeated emergency expenses. Those are things that you want to look for in a profit and loss statement. When you see super high repair numbers, maybe from one year to the next year, it should be signaling to you, hey, what happened? Did something major happen? Is something structural going on here? That's so. I mean, and again, that just that leads into, if you can get your hands on 2 to 3 years worth of profit and loss statements for any investment that you are pursuing, and you look at the trends and the differences, that is always a wise thing to do, because you can read between the lines and find a lot there. Now, instead, repairs appear to be spread among HVAC, plumbing, electrical, paint, locks, and miscellaneous. This feels more like normal operations than a distressed property. Biggest risk for a buyer. The biggest risk is not occupancy in this deal. The biggest risk is expense normalization. If you underwrite taxes, insurance management, and reserves, you could easily add $70,000 to $90,000 of expenses that don't appear in the actual operating statement. That would reduce net operating income substantially. Now, every investor is going to have their own predetermined constraints of what they expect to have as far as cushion in a deal and what they're looking for. So either this situation fits you or it doesn't. Now, my conclusion is this is what I like. I like that it's 21 units under $2 million. I like that the actual collections are around $275 per year, that there's strong occupancy to the tune of 90.5%. Repairs do appear to be manageable. Nothing significant going on or red flags there. Workforce housing is in demand. I mean, like, this property back behind me does so well because it's workforce housing, and it is in extreme demand in our market. And the location services it very, very well. You got potential for double-digit cap rate, bottom line. Now, what you need to verify before making an offer: property tax bill. You want to see insurance declarations page. You want to see utility responsibility. You want to see any kind of management agreements in place. Why actual expenses are so low, you should ask. You want to see a trailing 24-month rent collections. We're just talking about seeing those financial statements over 2 to 3 years. CapEx history like roofs, HVAC, and plumbing. Now, your single biggest takeaway is the rent roll and P&L suggest that this may be better than the broker package indicates. Obviously, I've built a pro forma. I've built a financial model on this property. And, I filled in the gaps as best I could. But at the end of the day, based on the actual statements that we have from the seller, this could be better than the deal I've sized up, honestly. But only if the missing expenses aren't being excluded. If taxes, insurance, and management truly need to be added back in, the realistic stabilized cap rate is probably closer to 8.5 to 9.5%. If they're already accounted for elsewhere and can be verified, this could be one of the stronger, small, multifamily deals in our market right here at 700 Mitchell Drive. It's here. It's an alpha property in a market with tons of demand for workforce housing. I believe understanding Myrtle Beach seasonality is critical, because investors who know how to structure around peak season cash flow, off-season operations, and tourism demand patterns position themselves differently than those buying strictly on annual averages. I believe the strongest commercial investments in Myrtle Beach are often tied to population migration, healthcare expansion, retirement growth, tourism demand, and lifestyle-driven consumer spending. Myrtle Beach is transitioning from a purely tourism-driven market into a more diversified economic market, and commercial investors who recognize that shift early may position themselves for long-term upside. If you're considering buying a hotel, motel, or short-term rental hospitality asset in Myrtle Beach, understanding seasonality, average daily rate, occupancy, labor cost, and operational efficiencies is critical. The difference between an average hotel investment and a great one often comes down to management strategy, operational structure, financing, and knowing where value can be created after closing. Call me now at 843-360-1737 and let's break down the numbers and identify. Guys, let's run through the profit and loss statement for 700 Mitchell Drive. This is the actual profit and loss statement. It is set from April 2024 through March 2025, so not quite a full year. It's actually 11 months. You got prepaid rent as the first income item. Then you got rents. You got your total rents there. You can see $21,723.84. Then you got fees, late fees you charge people, We got total deposit forfeiture there. Then we got total operating. We're at $22,163.84. That's the combination of rents, prepaid rents, all income, and then all fees charged on it. In that first month in April, we got $22,163.84. Then you can see it jumps in May to $24,000. It jumps in June to $26,000. July $26,000. Goes back down in August to $23,000, and so forth and so on. Then we've got expenses. They've got a cleaning and maintenance expense for pest control, general maintenance and labor, landscaping, and cleaning and maintenance. Then you got your totals there at 305, 205, 855, 740, 205, et cetera, et cetera. Then we've got other, we've got legal and other professional fees. We've got total legal and other professional fees. We've got repairs, electrical, painting, plumbing, HVAC, heat, ventilation, air. We've got key lock or replacement. We've got roof repair. Looks like they had a $285 for 2 different months fee for the roof getting fixed. So those look like they're probably minor. We've got a repairs other. You probably want to dive into that and find out actually what's going on. Then we've got our totals for the actual month: $2,400, $4,500, $4,700, $375, $45. Then we've got supplies. They got some supply costs there. Utilities. We've got electricity. So you can see here that there's not a charge in the month of April. Then there is a charge in the month of May, not a charge in the month of June and July. So it's safe to say that the tenants here actually pay the utilities. I would be curious to know what those charges are for exactly. Water. We got some water there. We got total utilities. We've got other. We got equipment rentals. We got total other. Then we got some capital expenses like appliances. You can see there they've bought some appliances throughout that year. Then you got your total operating expenses: $3,700, $6,500, $7,000, $1,300, $1,300, $1,500, so forth and so on. Now, if you take all of your income, you subtract out the total operating expenses, you're left with the bottom there. It says net NOI, net operating income. That's the net income post all of your operating expenses. You can see in the month of April, $18,410, May, $18,190, June, $19,000, July, $25,000, August, $21,000. So we've got total, and then underneath that you can see total income and total expense leaves net income. And there's your net income right there along the bottom. $18,000, $18,000, $19,000, $25,000, $21,000, $24,000, $20,000, $19,000, $20,000, $20,000, $18,000, $14,000 for a total of $241,243.47 for that 11-month period. That's the profit and loss statement for 700 Mitchell Drive. Commercial real estate rewards investors who understand leverage, timing, operational value creation, and market positioning. Whether you're looking at multifamily, hospitality, retail, office, industrial, or development opportunities, my job is to help you identify where value can be created, not just where property is being sold. Call me now at 843-360-1737 and let's identify the opportunities that make sense for your investment goals and risk tolerance.